For more reaction to all of this, let's turn to Tom Michaud, the CEO of KBW, a Stifel company. Tom, great to have you here on set.
Great to be with you.
Do you believe that the Fed's going to end up going 2 more times?
I think the economy's slowing. And when I look at what happened today, I believe more the statement, more about watch what they do rather than what they say. And I think the dots are going to be the most least reliable of everything that was communicated today. So what I see is that the economy's slowing. So I think we're near the end of this rate increase cycle. And frankly, if we get another 25 basis points or not, I think the outcome in the economy is going to be very similar.
So it sounds like you don't believe what the Fed is saying right now.
I think trying to deliver a new message with these dots is not what I'm willing to hang my hat on from what I see happening in the economy. Okay. I think that banks were already tightening in the fourth quarter of last year. It didn't just start in March. Loan growth had been slowing. For the banking system, the first half of the year is an adjustment to the new interest rate environment. In the second half of the year, we're going to be talking more about credit quality. And then the other thing is, whether it's technically a recession or not, I think it's going to feel the same way, because even like what you all were just talking about, it's different sector by sector. So if you're in the large corporate commercial real estate business right now, you feel like you're in a recession already. Frankly, investment banking revenues have been in a recession. Residential mortgage origination has been in a recession. So it's almost vertical by vertical.
The main reason for the Fed holding off this meeting is to see what the effects of the prior rate hikes will be and how they play out. So how do you see the long and variable lag effects playing out? What do you see that you think the Fed may or may not be missing? Because it seems like you're seeing the impacts right now in a much deeper sense than what the Fed has portrayed during the press conference.
Yes, I think there is a delayed impact. And I'll also say 25 basis points at 5% is very different at 25 basis points off 50 basis points, for example. So this is getting to be the real deal at the moment because of the level of rates. And so I think the bite of these higher rates is gaining traction almost every day. Even if you look, there's a lot of talk about how home sales are down in America. Part of the reason why I think that is because America loves their mortgage. They don't want to get a new mortgage. I've never seen America love their mortgage like they do right now. Because when you buy a new home, you have to think about financing it at current rates, and that's a good incentive to stay in your current home. So these are having an impact slowly, and I think the latest data on inflation is showing that disinflation is here, and at least in our area of expertise in financials, we see it in the fundamentals.
So Tom, if rates stay higher for longer, and you talked about banks and you talked about people, that essentially have to finance mortgages, how about banks that have to finance deposits? And if we had bank failures over the last 3 months, rates staying higher and possibly moving up a little bit higher, I mean, this is the part I can't reconcile. And you're talking about credit. You've been through these cycles before. Yeah. This might be the most foreboding of all storm clouds, no?
So I think there are 2 pieces to this conversation. One is, I think there are elements of like the global financial crisis that are in bank stocks right now. And I think the rally that we've seen since early May is a relief rally that's not happening, right? The other part is the earnings estimates haven't settled. They haven't stopped going down. So before the first quarter, we cut bank estimates by 11%. After the quarter, we cut them by 4%. My instincts are we're going to cut them again. And that's why the stocks are trading at 6 and 8 times earnings. It's because we don't really know where the earnings are going to settle in. But my sense is when we get close to hitting that point, and if the Fed stops raising rates, that's when we're going to find that out. I think that's going to be an important signal for investors.
Do we not see the floor in bank stocks until the Fed stops cutting or until we solve? I know that you've been, you've testified on the Hill about reforming deposit insurance. Is that another key aspect of stabilizing the sector for good?
Yeah. So what I think is, I think there is more relief rally in these stocks. I look at U.S. Bancorp, which is one of the trophies of the banking industry. Trades at 6 times earnings, 6% dividend yield. We've trimmed estimates, and we still think they're going to earn 20 on tangible common equity next year. That is an inexpensive stock that's a trophy that's on sale. Stock may not do much in the near term, but we think in the next couple of years you'll be happy if you bought it. So that's the relief rally. The overall industry rally for all participants probably doesn't happen until we get some more stability in what we think the earnings are going to be.